Keki Mistry, Vice Chairman and CEO of HDFC Joint, just to walk us through what transpired for HDFC Limited for the quarter gone by. Morning, Keki. We reported 8.5% growth in net interest income. While profits were largely bumped up because of one-time gains, barring this one-time gain, how would you classify profits for the quarter gone by?
I think this one-off gain that you're talking about is something which was disclosed to the market in January itself. In the early part of January, if you see the declaration we make to the stock market, we had mentioned that our shares in GRU got converted into Bandhan, and consequently there would be a 9,000 crore mark-to-market gain that we would have on those shares. So this is done because of an accounting requirement. Now, because we had more profits, we've been extremely conservative in our provisioning. And for the quarter, we have charged as much as 2,995 crores to the P&L account towards provisioning. If I was to summarize the quarter, I would say that from an operational perspective, it was a very good quarter. Our trust on affordable housing loans continued unabated. We have, if you look at this quarter, 18%, of the loans we gave in value terms and 36% in number terms were to customers who were in the lower income group or in the economically weaker section. Our average loan amount to customers in the economically weaker section was 10.2 lakhs and to customers in the lower income group was 17.6 lakhs. That's as far as the operational part is concerned. So demand continued to remain good in the affordable housing segment. As far as spreads are concerned, spreads remain more or less the same as they were in the last quarter. The spreads in the September quarter were 2.26% and spreads as of December stood at 2.27%. There was a 1 basis points change in spreads. Net interest margin remained almost exactly what it was. So, net interest margin actually has remained stable for a long time. It was 3.3% in March, 3.3% in September and remains at 3.3% in December. Non-performing loans moved up slightly compared to what it was in the September quarter. In the September quarter, we had non-performing loans of 1.33%, and in December, the non-performing loan level stands at 1.36%. And we have been extremely prudent, extremely conservative in our provisioning. If you look at the quantum of provisioning we carry in the balance sheet, it is much higher than what we would need to provide if we strictly follow the NHB guidelines with regard to period of default.
Mr. Mistry, you mentioned that you've been extremely prudent and conservative in provisioning. Going forward, what's the provision coverage ratio that you're targeting, and will you continue to be conservative?
To my mind, we've always been conservative in our provisioning. We continue to remain conservative in our provision. I would even go to the extent of saying that 36% of the loans for which we have provided are actually loans where there is zero default. It's just that because of whatever reason, we want to be that much more cautious and we've created provisions on those accounts. So we've been very prudent. I would say we've been extremely prudent in our provisioning policy.
Right. Keki, your gross net NPA saw a marginal increase on a sequential basis. What's the reason for that? What are the asset quality trends that you're seeing both in retail as well as developer loan portfolios?
So if we look at the breakdown of the non-performing loans between individuals and non-individuals, out of the 1.36% of gross non-performing loans, individual gross non-performing loan number is 0.75%. and non-individual non-performing loan number stands at 2.91%. If you were to look at this number last quarter, as you said, in the individual category, non-performing loan number would be 0.73% and individuals would have been 0.73% and non-individuals would have been 2.87%. So there is a 2 basis points inching up in the individual category and a 4 basis points increase in the non-individual category with an overall increase of 3 basis points. 3 basis points means 0.03%.
Disbursements witnessed a growth of 13% year-on-year led by retail segment. Will individual loans continue to dominate your portfolio, and where do you see the share of developer loan book dropping to?
Look, making a futuristic statement is very difficult, but I can give you on a past basis what happened. So individual loans on a balance sheet basis constitute 76% of our loans, and corporate loans constitute 5%, developer loans constitute 11%, and lease rental discounting loans constitute 8%. So that's the split of the loans on a balance sheet basis. If you were to look at incremental growth for the quarter, just for the quarter, in the third quarter, then 81% of the growth came on individual loans, 19% came on non-individual loans. If you were to look at the 9-month period, April to December, then 90%, as much as 90% came on individual loans and 10% came on non-individual loans. So several quarters ago, I would say almost 6 quarters ago, we had guided the market to say that we would be extremely cautious with non-individual loans, and therefore over a period of time you would see there would be a reduction in the level of non-individual loans that we've done. Having said that, we have our foot close to the accelerator. Whenever we find that the market sentiments have got better, things are looking up for the real estate sector, we'll quickly press the accelerator and take that growth much faster.